Going to be talking about what's going to be covered here. The purpose of the special series is to share an overview of macroeconomic and monetary policies for maintaining economic and price stability. First part, I'm going to be talking about price stability. This is the most important in this particular part. That's where it will be covered up. There'll be a bit about economic policy also. I'll be talking about unemployment rate. But however, as the module progresses, it's going to be much more larger. There are a lot of subtopics that will be coming in. Now, some of the topics which you could check would be around these lines. So, open market operations is a separate module. Phillips curve, introduction to Phillips curve is a separate module, but it will be covered a bit in this particular module as well. When we are going to be looking today, we'll be predominantly looking at central banks. We look at their mandates. What do they do? What is the major policy rate? We'll see their role as a lender of last resort. This is a separate module also on that. And then we'll be looking at some of the frameworks in managing monetary rates like Taylor's rule, Montague rule. There'll be an introduction to linear regression analysis, which is already there in one of the modules, which is a subset of this module, and will also be covered in, a part of it will be covered in this series. Now the references, as I always talked about, two books from macroeconomics by Gregory Mankiw and Mishkin, macroeconomics policy and practice. I suggest you go through also all the macroeconomic modules at the middle road. These are key references and research papers which have come in. This is a very good list of papers you could read. Some of them have directly been used, some have been indirectly used. So this is a very good list of reads which you can refer. Quick recap, we've seen the short-term fluctuations. Whenever we're talking about short-term fluctuations, the short is measured by real GDP. These are recessions and expansions, and these are caused through shocks to aggregate demand and supply. Now we'll see this through a change in the output when rate, price levels. So whenever I'm talking about price levels here, it implies inflation. Now a quick recap between long run and short run. We see aggregate demand. Now in the long run, the aggregate demands impacts price level but not output and employment. In the short term, prices are sticky. The prices of a lot of products are sticky. Not everything is sticky. Therefore, it impacts employment and output but not prices. We have I think covered before this particular aspect that in aggregate supply in the long run is determined by the amount of capital, labor and level of technology. The production function we had touched about in one of the modules. I suggest you look at it. Central banks are huge enablers. Basically, they set up the short-term rates, they set up the lending rates. They also influence long-term rates. These are rates very important within the whole social impact of whatever you do, whether you're working in a non-profit, whether you're working in a foundation, or whether you're in a business, or you're working in a multilateral bank. This is the deciding force, the economic environment or the social impact environment. The economic environment affects the social impact environment. At central bank, one of the key or the major selected functions is to promote monetary and macroeconomic stability. Would have, whenever they have monetary agenda, they could be either dual or hierarchical, so which is in this case they would usually have one mandate, but they will also look at mandate, but that one mandate is the most important. So the major factors which they look in is price stability, maximum sustainable employment, which we look through unemployment rate, growth of the economy, and currency stabilization. So currency stabilization among the major bank is followed by People's Bank or Central Bank of China. Now they also promote a sustained and efficient financial system. They implement regulations for a smooth function of the economy and also for a smooth payment system. So these are some of the selected functions, but we'll predominantly look at the monetary aspect today. We have, and you've seen this in predominantly other parts also, why I have kept the other price stability, set interest rates and moderate long-term rates are all monetary policy. The reason why I've kept maximum sustainable employment, because we'll be looking at, when we're looking at Taylor's rule or when we are looking at Phillips curve, this is a very important factor. So that's the reason why I have specifically mentioned this is more of a macroeconomic policy. One of the central tenets of a central bank now is lending as a last resort. There are three tools for this particular function which a central bank uses. It predominantly goes to the open market. And when we're talking about open market, there's a special module which you need to refer, to have a fair bit of idea what an open market is. So they use it for repo and reverse repo. The other way is that they purchase assets or do quantitative easing in the open market, permanent, this part. And the third is they give distressed lending to financial institutions when there is systemic risk within the system. Now that could be either the financial institution goes to the central bank or the central bank goes to the financial institution. It could take place in any way. So there's a very good research paper, Central Bank Tools and Liquidity Shortages. I suggest you read it. This is will give you a very good, prominently a very good perspective on how about lending as a last resort. Now when we look at monetary tools, we are looking at temporary money open market operations. That's where we are talking about repo and reverse repo. It's basically used to manage liquidity within the system. You can say reserves within the system. And it is used to adjust short-term rates, basically policy rates like effective Fed funds rates. So just give an example. When you're looking at permanent open market solutions, basically asset purchases or quantitative easing. This gives you a fair good of idea of both of these operations, whether temporary or open market, and this is discussed in the separate module. We are looking at assets, outright assets purchases. We have Riksbank. This is the central bank of Sweden. It is the oldest and one of the most prestigious central banks in the world. Now you could look at the asset purchases over a period of time, which has just gone up. When you're looking at the asset purchases, basically majority of them is domestic securities, which you can see. Now this is just to give you an idea how the banks, if you're looking at a central bank, how the assets have grown over a period of time. This is a very good analysis. So I looked at the total balance asset size of Bank of Canada, basically the Central Bank of Canada. And if you look at the asset purchases over a period of time, you will get specifically when the major distress was during the Great Recession, you could see how much has been the purchase during that time. So you see 40.79 has gone from this particular part to the function here, which I've given 78584. So this gives you a fair bit of idea that in 2018, the Bank of Canada had increased asset size by 45.79% from the case of 2008, from the arrow which is mentioned. This gives you a very good idea. And if you look at, and I looked at the graph and I looked at the peak. So if you look at the peak was in 24/12/2008, which is about $81.53 billion. This part is Canadian dollars. It's mentioned here. And if you see how the balance sheet had come up, and then over a period of time as the economy grew, the balance sheet was cut down. So this gives to give you a very good idea of how the balance sheets move over a period of time. This is another graph which I use. It's percentage of nominal GDP is the total asset size of United Kingdom. It's Bank of England. This is another very prestigious bank and also one of the oldest banks, central banks in the world. Very good database. You could go to 3 centuries. They've taken our macroeconomic data, and I think this is a fabulous achievement on part of Bank of England. You could compare prices from 1725 to now, so it gives you a fair bit of idea as the explosion of the economy and the population grown, how the balance sheets and how the behavior of the central bank and how it's developed over a period of time. I would suggest that this is one of the best databases you can get. This, if you look from 2007 to 2018 is what I've seen. This is in RMB. It's in RMB yuan billion, and it's 270.1%. So you've seen over a period of more than a decade, just a little bit more than a decade, the increase has been tremendous. When I was talking about hierarchical and the dual mandate, these are the central banks. So whenever you're talking about price stability, it could be you're directly looking at price, which we'll look at, or you see a percentage change in the price, which is much more easier to manage. Inflation is actually, whenever you're talking about price levels, the majority of the central banks have tracked are actually using inflation as the mechanism. So you can see Canada, New Zealand, Sweden, Australia, ECB is European Central Bank. But if you look at the dual mandate, so US and New Zealand have a dual mandate. So they look at sustainable employment and inflation. So there's a trade-off. That's what I was talking about. So they look at both the mandates. In this, inflation is the first target. When they're okay, inflation they could look at. But in this dual mandate, they are both of them play a very important role in making decisions. So that's the difference between a dual mandate. You're looking also as a dual mandate, you have People's Bank of China. It looks at stability in the value of currency. Basically, if you look at stability in the value of currency, it becomes very important because this is a key factor, one of the critical factors, I would say. I'm not sure how much it's a critical factor for China, but for India, and we'll see, for inflation. So this makes sense to a certain extent of why, the China is looking at stability of value of currency. Not economic growth. Now, Reserve Bank of India, which is the Central Bank of India, you're looking at price stability and economic. When we are talking about inflation, there are two types of inflation. You have demand and cost push. You have pulling, which is basically your economy is very heated up. You have demand for goods and services goes way more than the supply of goods and services. But when you're looking at cost push, basically any of the goods or services more expensive, I would say that it would be some of them, which I've covered here, is import prices, capital flows, exchange rates. Reserve Bank of India has done a study and it's come out that based on non-parametric approach, import price inflation on average accounts for 2 to 1 percentage points of increase in domestic inflation. Now, this particular aspect is gives you a very good idea. And if you look at even how the import prices are going to be contributing, you could go through the data just to give you an idea. Now, when you are looking at inflation, we will be actually talking about consumer price index, which is basic. We could talk about as cost of living index, CPI. Now, this is a very good definition given by Riksbank. You could go through it. What's the relationship? In a way, you could say that you're trying to see how is your purchasing power. That should not go down. Try to track inflation because you want to see how is your real purchasing power. The real purchasing power should not go down. So when you're talking about cost of living index, it compares price and consumption level of the population. There are two types of inflation when we talk about. One is core inflation, which is very important. It is inflation which is without energy, food, alcohol, or even tobacco. Now, some countries US looks only at energy and food. Some countries look with alcohol and cigarettes as well. The whole idea is that these are very volatile. This is because to supply disruptions. When you look at supply disruptions and you want to, these are transient variables. You want to sort of remove them. That's the reason why core headline, but it depends. Fed looks at core inflation, whereas a lot of other central banks like ECB gives a lot of weightage also to headline inflation. Or what sort of parameters are you looking at? Like I talked about, headline inflation is what you're doing through CP. You have GDP deflation, inflation rate. You could check out the modules on the middle road to know more about it. The core inflation, which I talked about, which is less volatile and it removes, and we looked it through graphs. Then you have harmonized price index of consumer prices. This is an ECB. So this particular is used in ECB, central bank tracks it. And then you have CPIF, which is with fixed interest rate. Now, one of the reasons why we use fixed interest rate, we look at this. This is something which Bank of Sweden or Riksbank has come out, and we'll see what exactly it means. Now, the method could be like point estimate, interval within a band. It could be 1 year, medium, and ongoing. So these are the various aspects which different banks look at. Point estimate will be that point. It has to be at that particular point, whereas interval, it could move between a point. Look at what is the difference between core inflation and normal. So if you look at core CPI and CPI, you see in the blue line, it's less volatile. Now here, I'm talking about ECB. So ECB has excluded food, energy, tobacco, and alcohol. So this is a very good example. This is very less volatile. Just to show you, it gives you a very different picture if you take with CPI. Here again, I've taken CPIF with Sweden, I have taken, and then core price of Sweden. So here you'll see If I see, you see the blue line, and excluding energy, you see how less volatile it is. So this is just to give you a fair bit of idea. These are, annual percentage change month wise. So the inflation rate comes out monthly, and its data is freely available, Statistics Sweden and the Riksbank. And you could, just to give you a fair idea, that why core inflation is so important, much more important maybe than headline inflation. We come to the central banks now. When you're talking about the European Central Bank, they look at inflation below but close to 2% over medium term. And they look at harmonized index of consumer prices, basically harmonized so that you could collect the data from all of the regions and for your calculation. Now there are a lot of other factors also, but just to simplify, I've told you one of the factors. Now what do they look at? They have three tools, but the major thing is that these are the policy rates. These are the rates which will decide the lending rates to private players, or you can say to basically within the economy. The interest rate is main refinancing operations, which provides bulk of liquidity to the banking system. Talk about why you need a positive rate, and the ECB has defined a very good way. The positive rate is better than negative rate for deflation because it does not erode the buying power of capital over a period of time. This is the real purchasing power. I want to keep it constant or better. I will always want to go better, or it remains the same. But now this is I've taken the graph of how MRO, or the main refinancing rate, has moved over a period of time. Basically, it's you need a collateral. It is what the banks pay for borrowing money from ECB for a week. The other two is marginal lending rate and deposit rate. You could look it up. This is a very interesting, and this is which the banks are paid or pay depending on whether it is a positive or negative interest rates for depositing, we say, cash with the central ECB. And I came out to know about their index. So what is the HICP? So this is the major part. How much energy is a very small part, food is a small part, then you have services, which is one of the largest parts, which is about 41.83, and you have non-energy industrial prices. So this is a very good idea. It gives you a fair bit of what are the different components of the inflation. When we come to Sweden now, like I said, it is one of the world's best central bank and one of the world's oldest central bank. It was founded in 1668. This was also a quiz question, if you remember, on the middle road. Its policy rate since 94 has been repo rate. This is the rate which they target, which is what they want. This is the major policy rate. They target an inflation, point inflation over a year. And the inflation which they follow is CPIF with fixed interest rate. Now this is how the interest rate, this is how their inflation targeting has gone. Now this is how there's actually the rates are moved centrally. Now this is the repo rate of Sweden. This shows you the negative side. Now, and this is the negative side when you look at it, and you get a fair bit of idea. This is inflation should not have been here, just to give you this is the repo rate. Like I've talked about, this is a bit of special about Riksbank, and I'll be covering this a bit more. Their base objective is price stability. Now the inflation targeting was introduced in 1995, and it was actually in a range which was changed, but it was only until 2010 that the central bank had a tolerance inflation band. And I'm reducing the policy rate, which is the repo rate for Sweden. I'm reducing the short-term rates or the lending rates. As you reduce the lending rates, the mortgage rates also reduces, and this would actually boost the inflation in a way. When we're talking about demand inflation and pull inflation. But in fact, when you reduce the rates, you boost up the credit within the system, and it pushes inflation down. As the mortgage rates go down, which is a part of the basket, then it has an effect on the CPI. You don't want your policy rates to reflect in the inflation rate. That's why CPIF, you put fixed interest rates as constant, and that's very important. About the currency krona. So if we follow what they have done. So for example, you just sort of a small history from 1977 to 92. They followed a unilateral exchange system where the krona was pegged to a basket of currencies, and then which was the European currency unit. This did not last long. Then there was a collapse of the fixed currency, and which gives rise to floating rate which of the currency. That is the time when they also came out with the inflation targeting, and initially they look at headline inflation at 2% within a band. Now, which has changed now, like I've spoken before in 2010, like before, it has changed. For a period of time, if you look at their history, they followed from 1885 to 1961 as discount rate system as their main policy rate. Then they followed penalty rate system, and then they had an interest rate scale. So they're very interesting history. I just wanted to show you how the things have gone from a period of time and how different policy parameters have come in. Now this gives you an excellent overview of how the price is done and inflation. So when we are talking about inflation of 2%, but what we don't understand is how much has the price levels risen over a period of time. At the rate of increase in the price levels over a period of time. So let's look from 1970 and to 2002. When I'm talking about price level, this is left index and right is giving you the change in the inflation. Over a period of time, these are the times in 20 when there's a very high inflation. You can see how the inflation rate was changing and pointer. And there is also an increase in the price level, which you can see. But this gives you a very good idea. When we're talking about inflation, what we are not knowing is the absolute price level, which is what we are targeting. That ultimately we are saying it does not, because as your economy is growing over a period of time, your price level is growing over a period of time. So inflation has moderated and stabilized over a period of time. If you look at from about 94 when they started targeting, if you look at the volatility of the inflation, which we will also look for another central bank, we see the volatility has come down. Go to Bank of England, you take, it's got a monetary policy committee which announces policy rates 8 times per year. So they target inflation and their policy rate is bank rate. But if you see the current policy rate is at 0.1%, inflation is 0.2%. They also targeted different ranges over a period of time. I've listed changes in bank rate, minimum lending rate. So this is very interesting. They're taking at official bank rate, but they also have tracked repo rate. So you see how the rates have come down. Now we are living in a world of extraordinary low interest rates for a very long period of time. Now we come to Federal Reserve, which is the central bank of United States of America. They track the policy rate is effective Fed funds rate. It's known as Fed funds rate, 0.07%, and discount rate. Now, when we talk about the Fed rate, it is the basically rate which depository institution of banks lend each other overnight. It's unsecured. It's determined by the market. We looked at open market operations. Now, the open market is something which I discussed before, and you can look at it. Now, discount rate is the rate which is the interest rate charged to commercial banks and other depository institutions on loans they receive from the Fed. So the Fed is going to be charging you, and that's known as the discount window. Now, there are 3 types of this. You could look at primary credit, secondary credit, and seasonal credit. But let's look at how it moves. So interest rate or discount rate is very close to effective fund rate. So ultimately, there is a very small basis. You can say there is a small spread between the two. Basically, the discount rate tracks the Fed funds rate usually. This is a small idea of how the inflation and unemployment has gone over the last about a year. So just to give you an idea, and this is the effect what happened in the pandemic. It sort of hit one of the record high unemployment rates, and then it came down. People's Bank of China. So they value stability in the value of the currency and promote economic growth. This is how their basically policy rates are looking. The rates are at about 3.85%. Got this graph directly from Global Economy, and the data which they got it is from the Bank for International Settlement. This is what I took out the data, and I sort of did analysis to see how the currency has moved. If you see from 2011, at this particular peak which we look at, they have been between a very smaller range. So they have stabilized their currency very effectively. Now this is something which you can easily see it, that's less volatile over a period of time in the recent years. And you also see that inflation has drastically come out. So if you look at right from the time the currency got stabilized, the inflation, at least, which you look at, this is my deduction, has averaged about 2.15% from 2012 to 2019. Even this has got stabilized. So when we look at and we try to analyze this, we could think that a currency stabilization could have had an impact. We can see the casual impact. And we can also do an analysis to see how much of a currency stabilization could have had an impact on stabilizing the inflation. So this is something, whenever we talk about India Reserve Bank, it's got dual mandate of price stability and growth. Its targets headline inflation at 4% between a band which is 2 to 6%. There are other tools, marginal standing facility. These are all tools of other banks, which you have CRR, SLR. These are tools which are there which also monetary tools which every central bank has to regulate the liquidity. Just to give you the inflation, India inflation versus GDP, I have not taken 2020 because that would have come negative. I think India was minus 8% negative at that point of time. It was one of the worst performing countries in the world. If we look at New Zealand, this is one of the best central banks in the world. They have a dual mandate, which is CPI, keep between 1 to 3%. They target over a medium term, but they look at the midpoint. Now, the policy rate is official cash rate. You could read a bit about it. There'll be you can visit in this particular graph. I wanted to show you the unemployment rate and OCR and how the CPI has changed. So I know it comes out as too much of data, but I just wanted to show how the unemployment rate, because this is a dual mandate. This is one of the prime things in part 1 which I've covered, basically how the CPI and unemployment rate has moved over a period of time. That's why I kept on talking about why unemployment rate I'm looking at and price stability, is because is there a trade-off between maximum sustainable employment and price stability, which is example inflation. Whenever we are talking about, like I spoke before, in the dual mandate, the stable prices could be price level, but this is predominantly more difficult to target and people easily target inflation. You could look at Canada, just to give you an example how inflation and unemployment has been over a period of time. The correlation analysis. Now, in the next slide, as we look at the Phillips curve, why this particular correlation is there, we see they are negative correlated almost by 80%, 0.8. So, which means that if the unemployment rate increases, if the unemployment rate increases, the inflation rate decreases. The unemployment rate increases means employment rate decreases. These are some of the very important aspects. We come to the Phillips curve of why we are looking at these two mandates. A.W. Phillips was an economist from New Zealand. He has came out with a relationship. He was in LSE, London School of Economics in United Kingdom, and he came out with his analysis for unemployment rate and wages, and which was negative. Now, the thing is, in economics, inflation is by far much more important than wage growth. Wage growth is predominantly goes into inflation. It's one of the major factors of inflation. It raises the price level. It also raises the aggregate demand within a nation or an economy, leading to rise in inflation. It should be predominant thing. And then you have the negative relationship between unemployment and inflation is known as the Phillips curve. When we are talking about Phillips curve, in the long run, we have to see the economy runs on natural rate of unemployment. That's why this is going to be vertical. In the long run, the inflation and unemployment rate have no causality. There is no relationship. But in the short run, we see there's a negative effect as the unemployment rate, which is the independent variable. And when you look at causality and we look at regression, this is the one which is dependent on unemployment rate. As unemployment rate increases, inflation decreases. And as unemployment rate decreases, so here the unemployment rate is decreasing, the inflation rate increases. These are the two. So it's a downward sloping. But is the Phillips curve flattening? There have been instances like in the 70s and there was high inflation, and now which has come out that is in Phillips curve flattening. So this is a very good read. You could have put in the article's name also. And this is true. The Phillips curve is flattening of the late, but in certain analysis, it's flattening maybe across the world. And we could look at the reasons why. We'll also do some analysis to see how the Phillips curve is panning out in other economies. Now, we look at the selected framework for central banks for managing monetary policy as a function of inflation. We'll not go very deep into it. We look at Taylor's rule, this very famous rule, and it basically gives you, when we talk about nominal Fed rates, the real Fed rates would be nominal Fed rates minus inflation. So you could look at, when you're looking at Fed rates, it looks at 2 plus 0.5, which is inflation minus 2. So it looks at inflation as one part and GDP gap as another part. There are various ways to calculate it. And one way is to, whenever you're looking at inflation, you look at gross domestic implicit price deflator. So that is the variable which you should be looking at. And when you're looking at GDP gap, one of the ways is to look at real GDP minus the real potential GDP, which is, you say, the natural level of your growth by real potential GDP into 100. This is how it's being calculated. I've used it. You could use the data. You can also get the data from the Fed. These two graphs. Now, when I plotted these two graphs, you get a fair bit of idea where the interest rates should be according to the Taylor's rule and where it is right now. So, Mr. Mankiw, like I talked about, the economist Mankiw, who's come out with his own rule. He has said that the Fed's fund rate is equal to 8.5 plus 1.4 into core inflation minus unemployment rate. The only thing is that the data for core inflation and unemployment is seasonally adjusted. Both are monthly rates, whereas the Fed effective fund rates was not seasonally adjusted. And if you look at, it moves very close until we see this inflection point where according to the model, the rate should be much higher than what it is right now.
I got this data from United Kingdom. Now I've calculated standard deviation of CPI for preceding 40 quarters. How the volatility has come down. If you look at this graph, you can easily see that over a period of time, central banks have done a tremendous job in containing inflation. But then there is a catch. Is it because of their efforts or because there's more availability of data? Look at a lot of papers which have come out on this particular topic, and I leave the verdict with you.